Our first keynote speaker, as Simone mentioned, is Bryan Falchuk. Bryan has spent 25 years in P&C trying to make the industry better and create opportunities across his multitude of roles over this time. He has been a carrier COO, Chief Claims Officer, Consultant, and Chief Growth Officer at an InsurtechLIVE startup. For the last 5 years, Bryan has focused on his future of insurance books and podcasts, creating insightful discussions on success, innovation, barriers, and challenges across legacy and startup companies. Bryan says, like most, he fell into the insurance industry, although maybe the seed was planted when he saw his first Ferrari and his dad immediately said, "Do you know how much that costs to insure?" His desire for a Ferrari may have died, but his passion for the industry has only grown. Bryan and I will be running through a Q&A at the end of this session, so make sure you're putting through your questions to Slido. Welcome, Bryan.
I should say, my dad does not work in insurance, so I still don't know why he said what he did. I also talked about wanting to get a tattoo, and my sister was like, "What would you do if one of your kids got a tattoo?" And he said, he's Venezuelan, he goes, "First, no insurance, then I cut them off." Like, I don't know why the insurance is, so maybe it is actually not by accident that I got into it. I want to talk to you not about tattoos and my father saying funny things, but what I think is a really difficult and transformative moment of challenge, but ultimately opportunity that we face in this industry that everyone here, regardless of what part of the industry or ecosystem you're in, is living. And here is not just in this room or even just Australia. This is a global issue because the things I'm talking about are happening consistently everywhere. I just gave a talk around this same topic a couple weeks ago in my hometown in Boston. And I was in the elevator leaving the event afterward, and some of the people were like, "Wow, you really scared us, so we're all going to be out of work shortly." That is not the intention. I hope you take a more opportunistic and positive view of this, because it is a challenge, but challenge, of course, is that moment where we can do something to really build for the future. So it's actually really apropos that Michael kept mentioning Mother Earth, because that's a lot of what we're talking about right now. And I know we can't be in this industry and not realize several of the things that are going on. So these challenges that we face, they're actually not new. They're things the insurance industry has dealt with for generations, hundreds of years, really. It's part of why we exist. We are facing a number of challenges right now that there's both a severity and a frequency elevation going on, really a confluence of them. And that's what makes this moment a bit different than the things we faced in the past or the way that we faced them before. So there's sort of three drivers of the material difference in this current moment that I don't think are temporal. I think it's a shift in the way things that we face work that we need to be thoughtful about going forward. So I'm going to scare everyone terribly right now, but I don't think I'm saying anything new, but then build you up for the path ahead. So just stick with me, keep hope alive, and we will get there. So the things that are going on first is climate change. And if you can't tell, I'm from the US, so of course half the room would be like, "I don't believe in that," like it's ghosts. I think everyone in insurance believes in climate change because we live it every single day in any line of business. You understand climate-related losses are increasing in frequency and severity, and the gap between them is shrinking. That is different, and I'll have some data behind that in a moment. And of course, that materializes in losses, whether we're paying for them or not. You certainly have all lived that in Australia. The fires in 2020, there's fires now. Obviously, we're dealing with that in the US as well. Flooding going on here. The really weird confluence of fire followed by flood, which is what LA is dealing with right now, where the ground can't keep the water, and so you get these massive mudslides with a lot of debris. It's terrible. These kinds of things are happening more and more. Scientifically, there's more energy in the atmosphere, and that's what's driving that, and that doesn't dissipate. It plays out. Second, supply chain pressures. So being in insurance, we deal with this every single day in all of the material losses that we face. The cost to replace cars, building materials to rebuild something, they've all gone up, not just in COVID, but they continue to go up. And while inflation is sort of mitigating in some respects, prices don't just reset back to where they were before. And there's people who will argue that on a non-nominals or real dollar basis, things are cheaper than they used to be. It does not really seem that way, and there are enough things that are not on a real basis cheaper that the supply chain is very constrained and it costs us a lot. And so kind of grabbing these last 2 points together, really high costs, they continue to go up rapidly, and even if you can afford the building materials or the car parts, you can't get them. And you can't get the labor to put them in, right? So we've got a lot of supply chain constraints all around, and that's not changing. Something in the US in particular that some other markets face too is what we call social inflation and litigation-driven inflation. This is a normal thing outside of the US as well, where just every lawsuit that settles for some dollar amount sort of becomes the floor for the next time. So you get this ratcheting up. People get desensitized to billion-dollar plus settlements, and then that's the next one that the plaintiff's bar will go for. So all costs are going up. All of this is happening kind of all at once, and that's different than in the past. I worked for a carrier called Beasley in 2011. My CEO is actually CEO at QBE now, Andrew Horton, and I remember us looking at, we had Christchurch, we had activity in Chile, there's all these like major catastrophes all at once, confluence of them. But then the next couple of years were stable, and the market had hardened, and we came back from it, and so it was okay. We're not getting that respite anymore, and that's what's different now. I was able to sit down with a professor of resiliency at a university in my hometown in Boston. This is from an upcoming episode of my podcast. Not that that's that big of a thing to feel excited about, but you all are getting a sneak peek. I just want to play this clip on his take on what's going on. Do you have the audio on this? So I'll summarize it. You can read it too. But two points he's making. One is the products that we have in insurance today, one of the things I've been saying is they've been developed sort of in the 1950s by and large and then iterated since then. His point is they were developed in peacetime, post-World War II. Obviously, some like marine insurance stuff goes back hundreds of years, but the core products globally that are in most markets were developed in a time of peace. That's not really the situation we're in. Whether it's specifically war, it's not really peace from the standpoint of a loss perspective. And that goes on to a second point, is they've been looking in his center at this university at the severe loss data going back 100 years, 1920 to 2020. And what they find is the gap between these severe events, what would drive the traditional insurance cycle was years, plural, before, and now it's months and single-digit months. So we just keep getting punched, and that curve has been sort of exponential. So that's why it's not, we have some big years and then it gets quiet for a while and we remake the money that the industry lost. There's a shift in the norm. Now, historically, we could respond to these things. And that's like we saw post-2011. We can raise rates. So we have big losses. We have to recoup so we can drive rates up. We can retrench. So you've got a market that's unprofitable, whether it's a geography, lines of business, or a market segment, what have you. You can pull out. Right? You're losing money, you're bleeding, you need a tourniquet. You raise rates, you pull back. Totally makes sense if things return to a sustainable, viable position, which is the question mark now. And lastly, you can cut costs. Now, I will say I'm a former management consultant. I love efficiency. I think it's great. And it's actually not the solution that we need. You cannot cost cut your way to long-term success when your core product is unprofitable. So we've had these three levers that we could pull. My argument is they're really not enough anymore because the game has changed. So I want to dig into each of these. The raising rates and the retrenching in some specific markets like LA right now, and I'm sure people are dealing with this with flood and with other things here, you get to a point where for a carrier, if you were to sell the product, the coverage, at a rate that the buyers could afford to buy it at, you lose money. So if you want to charge what you need to charge to stay in business, no one can afford to pay that. And so you get in this spot where the market ultimately has trouble clearing. And so in the US, we have these FAIR plans, the state-sponsored insurance solutions that are supposed to provide as a market of last resort that cover when the commercial market can't do it. They provide less coverage than you would normally want to have. So that's what a lot of people in LA are dealing with post-fire. I know people here are dealing with that in flood situations where the money you're getting from your coverage isn't actually enough to take away all the destruction and rebuild a livable space in a way that won't just get washed away next time there's a flood or the next time a fire comes through in LA. So you end up stuck where you've been paying for cover, and even though it's subsidized, it's still extremely expensive, and it doesn't actually make you whole again. That's not really a workable solution. So the raising rates and retrenching leading to this sort of market disconnect, that's not viable. Cutting costs. We love cost cutting in this industry. We focus on, you hear some of the startups in the US were especially focused on taking out the cost of agents and brokers. Like, oh, we'll just do away with commissions, and then isn't that great? It solves everything. As if customer acquisition is free otherwise. Because you're not paying a commission, you don't have to pay anything for Google AdWords and all the other ways that you grab customers. It's quite expensive. But even if we squeeze that down, if you look between the expense ratio and the combined ratio, which one's big? The expense ratio and the loss ratio. Loss ratio is 2 to 3 times the size of the expense ratio. So squeeze that expense ratio all you want. There is a point where you can't make it zero. Ultimately, the loss ratio is where the real dollars lie. I pulled some data for the US. I would love to get this for Australia. I'm not that talented, so I couldn't get it. But looking at expense ratio in the US, it's quite a similar story to a lot of markets. Over the 10 years, 2013 to 23, which is the last year I could get the statutory data, we've poured billions into expense reduction, systems and consultants and all sorts of things. And we brought it down from 28.1 to 24.9 points. So it's what, a 3.5-point reduction in expense ratio. It's brilliant. Good job. At the same time, the combined ratios, our overall profitability, went from unprofitable to unprofitable. Went from 103.1 to 101.5. If you don't know what combined ratio is, it's for every dollar premium you bring in, how much does it cost you? If it's over 100, that means you're losing money. So we went from losing 3.1 cents to losing 1.5 cents. That's great. I talk about it like bank robbery. If you robbed 10 banks last year and only 5 this year, fantastic. I'm really proud of you. You're not supposed to rob banks, so we're not there yet. But if you notice that expense ratio reduction was less than the reduction in the combined ratio, which means we're still losing ground. Despite pouring billions of dollars and huge efforts, we're not getting there. And the reason is, if you really look at it, the denominator to both of those is direct written premium. That has shot up through inflation and some other expansions, inflation of the insurance premium and the underlying assets. So if you do the math, the growth in the denominator more than explains the decrease in the expense ratio. So despite heavy investment, we're actually making negative progress on the expense side, and we're making even more negative progress on the loss side. The core product is that loss ratio. That's where the break is. One of the carriers, they were a top 5 in the US market in personal lines, had a particularly bad 2023. It was all over the news. They pulled out of their biggest states, gave up a lot of market share, and brought in a new CEO and leadership team, and they were going to lay off a lot of their staff. So they ended up doing an 11% reduction in staff. Their total staff costs were 15 points of combined ratio. So an 11% reduction is like a 1.5, 1.6% reduction in their expense ratio. They were writing at 118 combined ratio. So they, by laying off just over 10% of their staff and cutting all those costs, they only got themselves to a 116.5. It's not expenses. We keep focusing on that. That's not where the real problem is. It's in the core product and the profitability there. So what? So we can't cut expenses to get there. We can't just raise rates. We can't just pull out of markets. What do? I think we need to step back and recognize that the core product needs a rethink. And the way we act around that needs a rethink, right? We need to reset. So I think there's 3 things we need to focus on. And there's lots we can do in each of those. The first is risk itself. That's what we're here for. That's our industry, is about risk. It's about selecting the right risks. So what are we doing to prospect? How do we understand those possible markets, customers, segments, lines of business, et cetera? And then once we have them, can we make them better? AI is the buzzword. That's the only thing we get to talk about anymore. But there's another thing that's getting talked about a lot the past couple of years, and that's predict and prevent. right? Don't just take it and rebuild it. What if we stopped the loss from happening ahead of time? I have been hearing that as a war cry for at least the last 5 years. What have we actually done on that front? There are some pockets of success, like Honey is doing that here in this market. There's some other spots where you see some folks stepping in and doing some things, but on the whole, we're not predicting much, and we're certainly not preventing much. So we take the risk in, but what are we doing to actually make it better? Mitigation. There's a lot more we can do there. On the pricing side, one of the most fascinating things for us is we don't know the actual cost of product when we sell it. But once it starts to play out and we get the losses, we're seeing in real time what's happening to the cost of that product. But the feedback loop to go from claims back through to underwriting and pricing and product is incredibly long. So a typical carrier, it's like 18 months before you really get a new rate filed and in market and you're writing with it. Think about what happens over the course of 18 months. In the first 6 months of lockdowns and COVID, in the US, lumber prices quadrupled. So 18 months from that quadrupling, do you think that the prices went up 4x and then sat there for another year while you got your rates in? No, you were already well behind where they needed to be. So we're always behind the curve with the way that we price now. Same thing with product changes. We have to be able to get these things into market much faster and get that feedback loop really turning. Lastly is product. I mentioned a lot of the products that we sell developed in peacetime, like that professor who we couldn't hear. Like he was saying, 1950s, do you think cars are anything like they were back then? Houses, yeah, they look roughly the same, but the materials they're built with, the labor it takes to repair them, cars, the sensors in them, and all these things, wildly different. And that's before we get into EVs, before we get into autonomous vehicles. All of that stuff will change them even more. But we're still basically using the same policies that we used from 75 years ago, just slightly iterated every year for regulatory changes and a bit of competition and price changes. But effectively, it's the same cover doing the same things. That doesn't work when the exposures have really moved as much as they have. And of course, now they're subject to much more frequent climate-related losses and lots of other things. So we need better tools to adjust the product and better responses. So I want to go through each of these a little bit more detail. Risk, selecting better risks, prioritizing which ones we respond to. There's some really cool tools out there that can help us understand the propensities and proclivities of a given risk before we brought it on. So who do we market to? And then once it's come into the funnel as a request for a quote, which ones do we prioritize? I've worked in personal lines, I've worked in commercial and specialty lines. Typically, underwriters will respond to the first risk in the queue or the first request for a quote in the queue. That has nothing to do with quality. It's like when someone who's been in a job for so many years, it's like, well, they put in the time, they deserve a promotion. Maybe, but that's based on how they're performing, not that they've reached some milestone of years. Right? So why is this risk that happens to be the next one in your inbox the one you should be trying to compete on? Can we not see things about that risk before you even touch it? Using AI, can it scan through the PDFs and attachments and whatever else? Can it pull from third-party data sources and prioritize that work and load up our underwriting system so that we know what should we be working on and can we be faster and more effective when we do work on it so we can get back to those brokers faster and they start to understand, well, they're really responsive and competitive on these risks. I best send them more of those and less of the stuff that they're not even responding to. So you end up competing for and winning on the stuff you wish you had and getting more of it, so you get more of a chance to compete on it and win, and it becomes this virtuous cycle of a book that improves itself. There are already tools out there that can do these things for us. There's two that come to mind right away. Happy to talk to people offline about these things. I don't want to name companies and everything, but there are ways to start to do this immediately. On the risk selection, the company I show there, this regional carrier in Midwest in the US, Ohio Mutual, about $250 million, literally in the middle of cornfields, maybe soy fields, I don't totally know. It's fields of some kind. I've driven to their, the Waze took me off the highway. I'm like, this must be a cut through. I'm not expecting to see a $250 million company in the middle of, nope, right in the middle of farmland. Really cool company. They work with an AI solution that looks through their loss data and data on the insureds themselves based on people's habits and behaviors online and what it can pull together, and it models it, and it tries to predict certain behaviors. This is such a random use of a tool like this, but one of the things they predicted was the likelihood that someone has a wood-burning stove that they have not reported to you, which when you think AI is the first thing that comes to mind, is like, I wonder if they've got a fireplace that they're using to heat their home. It's not usually the cool tech kind of story you hear, but that's what they did. Because the way you learn about these things is after a house burns down that you didn't know had a source of fire to begin with, and someone died. And the reason why they burn down is typically poor maintenance. So creosote builds up in the chimney, could have been avoided. They ask about it in underwriting. Sometimes it was put in after the new business was written and people just forget to report it. Sometimes they don't think about it. Or maybe it is intentional and they're trying to save a bit of money on their insurance. Ohio Mutual worked with this AI solution to identify of those that they didn't say had a stove, who might have it. And on renewal, when we do our renewal questionnaires, let's take that population of people with a high propensity and go a step beyond and actually push a little bit harder, working with their agents to really get to the truth. And if we find there is one, it's not about canceling them, it's not about the leakage. Those are possibilities, but what we want to do is educate them and be a predict and prevent kind of solution here. And they found over 1,000, this is a small carrier, so over 1,000 risks right in that first year where they identified with extremely high accuracy, like the system said, yeah, this person probably has it. Lo and behold, they did. So really high overlap of prediction and actual behavior. And in only 2 cases did they end up canceling them. One of them, I think, is, I don't think anyone would write this risk, nor should they. The stove was homemade, so the person built it themselves. It was placed in their garage or garage, or I don't know how you'd say it here, but this is the best part of it. It was next to a giant drum of gasoline, petrol, that they used to fuel their, like winter snowmobiles and other things. And the homeowner refused to move it or move the gasoline. It's like, I get it's installed. There's just, can you drag this drum? No, they wouldn't do that. So that's one, there is no rate for that risk, walk away. You don't hear that in most of the AI hype, but I think that's a cool story because it's so different. It can do a lot of things for us, but that's about identifying the risks and doing something different with them. On the pricing side, just did a talk downstairs about the future of motor insurance. A big part of that is the ability to have a much clearer sense in real time of the exposure. That's such an issue in this industry, is the asymmetry of data and the fact that when we wrote it, it has a whole life cycle before we get a chance to adjust that rate again. What's happening in that window? So using more sources of data in real time to either have a more dynamically priced product, which you can do in some lines where usage-based insurance is an option, or to understand from a risk mitigation standpoint, is there a signal in this data that we should step in and intervene? Should we send this education bit to them? Should we reach out? Should we target them for these sensors that can help identify a non-weather water loss or something from a pipe burst and send them a sensor that they can put on their pipe themselves? There are things we can do to intervene along the way, but can we get signal back that informs our pricing? And do we have the systems that when we have signal that we need to do something to the price, can we actually get it to market rapidly and not fall into the 18 or 24-month cycle? Even 12 months is an extremely long time when you're dealing with a level of inflation, for example, that we're all seeing globally. I mean, that's absolutely an issue everywhere. Are there filing flexibilities you can use? So whatever your regulatory environment is, everyone's got constraints as a result of that. Sometimes the way you file, the words that you use, the way you structure it could give you more or less flexibility. Have you questioned the way you're doing that? Have you sought advice or help, or are you sort of falling into like, well, we've always done it this way, and it's fine, and we're still here? Okay, I have no interest in being fine. You're robbing banks. Maybe there's some other solutions to it, right? And be willing to stand against the hubris of the way we've done it is always right, or at least it's comfortable, so we should just continue doing that. Question if there isn't a way to do it differently. Is another video clip that I'm not going to share, although I did look younger in it. And incidentally, my friend Nick, who was on the show, has gotten like really muscular and fit, and we just did an event together, and it gave a really good laugh to the audience to see the two of us on stage 3 years after recording this, because he looks so much better than I've aged. But Nick's point is he's speaking about commercial auto and personal auto in particular, and how when we take the old approach of looking at historical losses, filing a rate change and a product change, and 18 months later it goes in. You're always doing things in arrears, and your business is eroding out from under you, and at some point you'll wake up and wonder what the heck happened here. That's not a great way to do it, right? And so his point is those who adopt ways to be more dynamic and responsive and understand the risk in real time will ultimately end up winning, because the better risks will go there because the prices are better for them and more appropriate, and the rest will be stuck. Lastly is about product, and this is one where the coverage that's being offered may actually have nothing to do with the exposure that's there anymore. Are you thinking about changing that? So I know flood is a key issue for that. In the US, hail is a huge issue. There's a startup there that has a parametric offering around hail. So if certain parameters are met, it pays out based on a schedule around those parameters. They also have a tornado cover that if you're in the path that the National Weather Service draws at some rating of, they're called the EF scale, is how tornadoes are rated, you get some payout typically within a day of the tornado coming through. They do something similar with hail. That's really brilliant, because these losses are driving homeowners' insurance rates through the roof to the point that people can't afford them, and carriers can't afford them either. So you're in that market clearing issue. What if you could carve out this dysfunctional part of the product that is no longer fit for purpose, where your only alternative is just sell a higher self-insured retention or deductible, which leaves people uncovered? That's not a great solution either. What if you carve it out and solve for it with a product that has a totally different economic structure? It's not free, but it should actually reduce their overall cost of coverage, because the part that didn't work as an indemnity cover might work better as parametric with different economics. They'll end up saving money, and you'll end up saving money as well. But are you willing to rethink that? Are you willing to take a totally different approach to how you cover risks? That may not be the right answer in every case, but it's at least worth considering it. Are you using excess and surplus coverage, or going to Lloyd's and using other kinds of capacity, setting up captives, working with partners? There are so many different ways you can start to carve risks apart. You can repackage it for the insured. They don't have to have a more complicated offering that you're worried they won't understand it. But you can solve for what's going on in your bottom line differently if you rethink it. And another great video, and this guy has a really cool, he's from Belgium, really cool accent, so it would have been nice to end with that. But hey.
And the way it was defined was based on insuring vehicles that were using combustible engines and vehicles that did not really have a lot of sensors to capture information. We have come to the conclusion that that industry, which was meant to insure those type of cars and how you repair those cars and inferring driver behaviors, is going to start declining now. Yeah. It has been growing for decades. This is going to be declining. What is happening is we think it's a completely different industry that's driven by very, very different forces that's emerging now that will take care of insurance vehicles that are electric vehicles that have tons of sensors, so you'll be able to understand real behaviors. There will be transfer of liabilities, and for that new industry that is very small now, that's going to be growing and replacing the old industry, we think that the winners and losers are going to be extremely different, and we are excited about it.
So Tanguy Catlin from McKinsey talking about the shift in autos, right? And that was on the back of a mobility event that they were hosting. It's really fascinating, right? Cars are changing, EVs, autonomy, et cetera. None of it's done right now, so you can look at it and say it's all in its infancy, but this is the moment where we get to plant those seeds. What if we had planted the seeds for the moment we're in right now 10 years ago? Be very differently prepared for it. So there are places where we see things moving. Are there things we can do today? And this is really that chance to, and I'm sorry for anyone who's downstairs and already saw this quote, but it's your chance to rewrite your own history instead of being overwritten by it. This is the stuff that I talk about for fun. I love trying to spark ideas that get people thinking a bit differently. I don't have to be right. I don't care if I'm right. Someone said, like, no one wants to be wrong. I genuinely don't care. I just want to have everyone in this industry thinking about, is this really the way it should be? Is there an opportunity for us to challenge things? Because the reality is, being fine is not really the answer. There's so much more at stake, and it's not just about profit. Ultimately, nothing happens in this world without insurance behind it. You know, we talk about putting people back together after the worst moments of their lives. That is absolutely true. There's a bigger piece to that, though, that the economy halts if risk stands in its way, and we are the reason why risk can stand aside so the world can move forward. And it's not just about business. It's about food being, planted and grown and transported. And I mean, it's like everything that happens has insurance making it possible. That's a really important lubrication to the movement of everything in this world. So we need to be successful, not just for our bottom line. So hopefully that's a bit of challenge and inspiration. Yes, I sell books. The economics of book selling is not great, so I don't really care about selling them. I just want you guys to take the ideas. But there's also little things in the corner, some white papers. If you go to future-of-insurance.com, those are all free. Put out the podcast. I just want to get people talking and thinking about this. And hopefully we can do that with a bit of Q&A. And do connect with me on LinkedIn, and you can tell me I'm crazy and stupid and you disagree. That's awesome, too. Let's just have a conversation about it. So thank you all very much.
Thanks, Bryan. I feel like you were talking exactly to E5, talking about prioritization, but I didn't pay you to put that in there. That's all right. We've got 2 questions here. So the first one, what are the differences and perhaps the tensions between selecting better risk and just simply removing risk that is unaffordable?
So there are some situations where you need to walk away when you're bleeding, right? That's just not an ultimate answer. So I'm a car nut, as the Ferrari story, and I didn't outgrow my love. Like what I grew into was I'm cheap.
Noted.
So as a little kid, I didn't understand what things cost. In the US in particular, like Ford made this big announcement, they're not going to sell any more cars, all SUVs and trucks, because they can't make money selling cars. Fine, it makes total sense when you're losing money on every car. Ultimately, what happens then when trucks and SUVs aren't profitable? What are you left with? You cannot just pull out of everything or just say, no, that's not for us, that's not for us. Eventually, you end up in the corner and you go out of business. There's a scale under which you can't operate because your fixed cost structure will kill you. So if you're just talking about pulling out or not doing this or that, ultimately, that's not a path. And I don't mean the extremes where you've got a guy who has a fireplace next to a gasoline tank. Like, that's a different story. Don't insure psychopaths. What I'm talking about is like, so there's a fundamental disconnect in this. Could we solve for that? And I think that's what's about selecting risk, pricing accurately, and thinking about other ways to cover. That, to me, is how you solve for it once you've stemmed the bleeding.
Another question here, and I'm not sure you know the answer to this from an Australian perspective, but maybe from an American perspective. What role does the government play in filling the gap in the increasing costs and risk?
Yeah. So I think this dynamic is universal. I don't know what's played out here or not, but I know we have these FAIR plans that I mentioned, which are the insurers of last resort. There's a lot of talk about what's going on in California with that right now. Ultimately, what's happening is that subsidized offering makes the cost of cover seem cheaper than it really is. So people end up making decisions that they should not have made. So if I can't afford this house in this neighborhood, if it's $20,000 a year for me to insure it, which it's crazy to say that's actually not an unheard of number, but I can get it for $10,000, which is still a ton of money to pay for homeowners insurance, maybe I do buy that house. No, you should not have bought, no one should have built that house in the first place, or if they did, it's no longer a viable place to live. The problem with government-funded insurance as it's played out in the US, or anywhere where you're gonna have a subsidized offering, is it distorts the natural market tendency for people to make a different decision. Now the problem is, you have someone living in the house now. Do you want them to be destitute? Like, this is why governments step in, is this is actually a major social issue. I just don't know that subsidizing it and giving people a distorted sense of market pricing is necessarily the right answer. So we need to figure things out. What I would rather see is more partnership around, for example, I mentioned hail, and there's analogs in every kind of loss. The US homeowners insurers buy a lot of new roofs for people. When you're putting in that new roof, we tend to build what was already there, which is probably a shingle roof, which is going to fail again probably next year when the hail season comes back around. Why did you put the same thing back on when you know it can't stand up? Well, because the cost of the resilient roof is too expensive, so we can't do that, and that's not what their coverage is for. Well, maybe we should figure that out. Maybe we should work with the supply chain to try to get the cost down, and now it's a delta. It's not a whole new resilient roof, it's just the extra 10 or 20% or whatever it is for the resilient one. Could we not solve for some of that through bulk purchasing, through maybe working with governments to, if you're going to subsidize anything, subsidize the rebuilding of something with better building codes that will stand up? I would love to see that going to a mitigation strategy versus let's just subsidize what is not sustainable in the first place.
We are right out of time, although there are questions flowing through, so I'm sure we could chat all day. But thank you so much for coming today and speaking to us.
Thanks for having me.